Hey everyone, welcome back to FX Limit, the place where we break down complex Forex trading concepts into bite-sized, easy-to-understand chunks. Today, we're diving into the fascinating world of fundamental analysis and how it can be your secret weapon in identifying undervalued or overvalued currencies. So grab your notepad, because this is going to be insightful. Let's kick things off by understanding what fundamental analysis actually is. In the simplest terms, it's the process of looking at the underlying factors that affect a country's economy and, in turn, the value of its currency. It's like being a detective, piecing together clues to form a bigger picture. Now, you might be wondering, how does this help in Forex trading? It's all about getting an edge, understanding what makes a currency tick, and using that knowledge to predict where it's heading next. So, let's go through some key indicators that can signal whether a currency is undervalued or overvalued. First up, we have interest rates. They're like the pulse of an economy. Higher interest rates usually attract foreign investors looking for the best bang for their buck, which can increase demand for that country's currency, potentially leading to an appreciation in its value. So, if you find a currency with rising interest rates compared to others, you might be onto an undervalued gem. Next, let's talk about economic reports. These are your monthly or quarterly updates on a country's economic health. We're talking about GDP, employment rates, inflation, and retail sales. Now, if a country's GDP is growing steadily, it often suggests a robust economy, which can lead to an undervalued currency gaining strength. Conversely, if inflation is rising too quickly, it might be a sign that the currency is overvalued and could face a correction. Political stability, or the lack thereof, can also heavily influence currency valuation. Stable governance can lead to confidence in a country's currency, while political turmoil can have investors running for the hills, causing the currency to drop. It's crucial to keep an eye on the news for any political shifts that could affect your Forex trades. Trade and capital flows are also vital indicators. When a country exports more than it imports, there's a high demand for its goods and, consequently, its currency. This could signal an undervalued currency poised for a rise. On the flip side, if capital is flowing out of a country due to economic sanctions or poor economic performance, this might be your cue that the currency could be overvalued. Lastly, let's touch on comparative analysis. This is where you compare the economic indicators of one country against another. For instance, if country A has better employment rates, higher GDP growth, and more stable interest rates compared to country B, then country A's currency might be undervalued relative to country B's. In summary, fundamental analysis is all about understanding the story behind a currency. It's not just numbers and reports, it's about interpreting what those numbers mean for a country's economic narrative. By keeping a close eye on interest rates, economic reports, political events, trade balances, and comparative analysis, you can start to spot which currencies are the hidden gems ready to shine and which ones might be just a little too shiny for their own good. Thanks for tuning into FX Limit. Remember, fundamental analysis takes time to master, but with patience and practice, you can use it to make informed decisions in the Forex market. Until next time, keep analyzing and keep trading smart. See you in the next video.